Although purchasing a house is an exciting time, and it is usually very stressful, there are some things you can do to make the process go smoother. Don't buy a new car, don't co-sign, don't spend your down payment.
My goal is to provide you with financial information that isn't gibberish. My videos are a representation of real-world problems that everyone wished they were taught in school. When I am not running numbers, I love to travel and immerse myself in other cultures. I enjoy spending time with my family, my spouse, and my adopted puppy, Harper.
What not to do when you get pre-approved and are in the process of buying a house. Don't buy a new car. It is easier to get approved for a vehicle than a house. Don't use your closing costs or down payment money. Don't co-sign for someone else. Don't max out your credit cards. Make sure to use the 80% rule, which we talk about in a different video. Don't do any credit searches or allow anyone else to do credit searches on your behalf. Don't make any large deposits into your bank account. Don't quit your job or lower your working hours. Don't move to another employment. What you do after you take possession of your house is completely up to you. However, by not following the do's and don'ts on getting a mortgage, it could have catastrophic problems. It is always easier to purchase a new vehicle than a house, which is why we advise our clients to not purchase a new vehicle while they are looking for a house or before they move in. Unless you purchase the vehicle in cash, but don't use the cash that is set aside for your down payment or closing costs, you should not be buying a new car while going through this process. Don't use your money for your down payment and closing costs. Even though we may have already proved that you have the funds, and seeing that much money in your bank account might be burning a hole in your pocket, don't spend it, as the lawyers will ask you to bring all of that money to them when you sign the documents. Co-signing for someone else while in the process of buying your own property is a bad idea for many reasons. One, your credit score will decrease, which could lead you to no longer qualifying for that mortgage. Two, we have to use that new debt, even if it isn't yours, as part of your debt, when we calculate what purchase price you can afford. Some lenders will pull your credit closer to when you take possession to confirm that you have not taken out any new credit cards and that your debt hasn't increased, as it could lead you to no longer qualifying for a mortgage. Making large deposits in your bank account can throw some red flags. If you have to deposit the large deposit, which is normally anything over $2,000, make sure you are able to prove where that money came from. When calculating your qualifying amount for your mortgage, I take 3 things into consideration: debt, credit score, and income are the 3 main topics. We have already spoke about debt and credit score, so that leaves us with income. The bank needs to confirm that you make enough to pay your mortgage, property taxes, utilities, credit cards, loans, etc. So you want to make sure you don't quit your job, lower your hours, or move to another employment while you're in the process of buying a home or getting pre-approved. There are some exceptions to moving employment or a decrease in hours, so make sure to speak with your mortgage broker or feel free to message me and I can look at your situation as well. If you found this video helpful, please subscribe. Below are the links for my blog, Facebook, and Instagram account. If you have any questions or ideas on specific topics you would like me to talk about, please let me know. Thank you for watching.